everyone, Zach Perry here. Thanks for joining me. We're going to do things a little differently. I'm going to do a standing video. I'm going to talk to you about how an investment grade insurance contract, or IGIC, how that grows, how it works, give you an idea, right? Because this is something, it's the chassis of a lot of what we do, of what I do professionally, and so I want to make sure that you guys understand how it works. And as is always the case, I'm going to start with the conventional wisdom. I'm going to start with, what are you used to? What are you familiar with? What are the shackles that keep you poor? Okay, what are people telling you where they're not telling you the whole truth, or that may not be true at all? So when you think about sticking your money somewhere for like long term, letting it grow, you're probably thinking in traditional terms, right? You may be thinking the stock market. Now, by the way, if you stick your money in a qualified plan, a 401k, IRA, etc., then most likely you're in a mutual fund. Now, there are some, for more savvy people, there's ways to do a self-directed, and you can do real estate and whatnot. But typically, you're going to be in a mutual fund. Now, when you sit down with your financial planner and you ask questions, you're probably going to be asked questions about risk. In fact, the financial planner has to ask you questions about your risk tolerance, because they have to take that into account along with your goals to put you in something that's suitable for your goals. And so they're going to be asking you about your level of risk, and you should be asking the financial planner about risk. But I'll tell you what the financial planner will say is the reason we put mutual funds. Now, a mutual fund, by definition, it's essentially a group of stocks and bonds, and it's diversification under the label mutual funds. So instead of taking $1,000 and investing in Amazon stock and sinking or swimming with Amazon, you're taking $1,000 and you're sticking $20 in Amazon, you're sticking $15 in Apple, you're sticking $18 in Marriott, you're sticking $12 in Southwest Airlines, and then you got some municipal bonds in there that are slower growing but safer. And then on the whole, when the stock, Apple stock may go down and Amazon may go up, and so on the whole, you're kind of leveling out your growth and hopefully minimizing your downturn. But of course, when the whole market shifts and it corrects on average every 9.875 years to a magnitude of about 44%, then your mutual fund goes down too. And in fact, a lot of times you can diversify yourself out of growth, okay? So if you ask your financial advisor for any sort of guarantee, the financial advisor will not give it to you. The financial advisor cannot and will not guarantee growth, because there's no guarantee. Now, if you ask, what type of guarantee can you give me? If the financial advisor is honest, he or she will tell you, well, I guarantee you that whether your money grows or shrinks, I will get paid, because that's a guarantee when it comes to investing in a mutual fund. The financial advisor will always get paid, even if you do not. Okay? So let's talk about how that, and that's conventional wisdom. Stick your money in a mutual fund because it's diverse, right? You've diversified your portfolio. It grows over time typically. You can recover from the losses. That's conventional wisdom. Let's talk about the investment grade insurance contract, and I want to show you how it grows, because unlike the mutual fund, which comes with no guarantee, the insurance contract does. In fact, if you want a projection year over year of how it is going to perform, the insurance contract is going to show you that. The mutual fund will show you how it's performed in the past, but it will not tell you how it's going to perform in the future. And if there is any sort of projection, it'll have all sorts of asterisks and disclaimers and qualifications there, because they cannot at all predict the future of the market. If you could, then you wouldn't need a financial planner. You could just invest in the right stocks at the right time, and you could go from $1 to $1 billion and never look back. So with the investment grade insurance contract, you will actually get a document, and it will line by line. It'll go year 1, year 2, year 3, year 4, right? It'll go all the way to age, depending on your age. It'll go to age like 120, 121, which will be maybe year 75 in your case, if you're in your 40s. So what happens is, we'll tell you, here's how much money you put in, here's how much your cash value will be worth. So paid, cash value, death benefit, we'll show you what the death benefit is, and we'll do the same thing year over year over year. Okay, now here are the assumptions that are built in here. By the way, there's going to be a couple charts here. In any, we call this an illustration. In any illustration, you're going to see at least two different sets of numbers, okay? One is the guaranteed and one is the projected, the non-guaranteed but projected and probable. And that comes down to how the insurance contract grows, because it actually grows in one of three ways. Well, in at least two of three ways, but three potential ways for growth. The third is up to you. The first two ways it grows are simple enough. There's a guaranteed interest rate. So the insurance company is going to guarantee you a certain amount of growth, and they will illustrate. There'll be one that says guaranteed. And this is where they take into account, and they'll give you the projections year over year. If all they pay you is the guaranteed interest rate, this is the type of growth you can experience. So that's the first type of growth, is the guaranteed interest rate. So you're never going to lose principal. This is market independent. So no matter what the market does, this is what you can count on. It's a contract. They're agreeing to be bound by these numbers. Your financial planner is not going to agree to be bound by any sort of growth. So they're contractually bound to this type of growth. It's the guaranteed interest rate, okay? On top of the guaranteed interest rate, you have non-guaranteed growth. Okay, and that's in the form of dividends. So your non-guaranteed growth is in the form of dividends. Now, when we say dividends, what happens is the insurance company, they're taking your money, all this money that you give them and that everyone else gives them, they are using that money, right? They're using that money and they're growing it on their own. It's investing and they're growing it, okay? Now, depending on how well they do, they will pay you a dividend, okay? So it's like when you invest in stocks and the stock does well, you get a dividend, okay? So they're not guaranteed, but here's the thing. We're using companies with a solid history of performance on dividends. In fact, one of the companies we use has paid dividends. If you guess how many years in a row? In your head, think, what's a good track record, okay? And I'll tell you, I'll beat it. 173 years in a row, they have paid the non-guaranteed dividends. Think about that. 173 years ago, the Civil War was still in the future, okay? So this company, since before the Civil War, through the economic downturn of the Civil War, all the other wars, the Great Depression, the Great Recession, all the economic downturns, they have paid a dividend every single year. And so when they give you that second chart of non-guaranteed, that has numbers, and these numbers are going to be higher than these numbers. When they run it out, okay, they're not guaranteeing this is going to happen. But hey, 173 years worth of history, if this is, compared to the stock market, this is a sure bet. If you're betting on something, guaranteed, non-guaranteed, but highly probable, because they've always paid dividends. Now, that's not to say the dividend's going to be the same every year, but that's how they get your business. When they can show a history of competitive, not just paying minimum dividends, but paying competitive dividends, every year they're going to pay as much dividend as they can, because they want to show this history, because people look at dividends when they're deciding which insurance company to use, and we look at dividends and dividend history when we're deciding which insurance companies to recommend to you. So this is the first way your insurance contract grows. This is your second way it grows. The guaranteed interest, the non-guaranteed dividends, that's how it grows. Now, what are these rates? It depends. Different companies are different. But here's another amazing thing about these, is they will actually show you the percentage rates year over year. Now, in the first year, the amount of money you put in compared to your cash value, this amount is going to be greater than this amount in year one, always. Because not all of your money goes towards cash value. Part of your money goes to pay the death benefit. And to mitigate that risk, because if you die on day one and they're giving you a huge check, that's a risk. So to help mitigate that risk, they're going to front load the cost of death benefit. So in the early years, for every dollar you put in, less than $1 goes into cash value, and so your cash value increases by less than $1. But in the later years, for every dollar you put in, your cash value increases by more than $1, okay? And they'll actually show you year over year what your rate of return is. Some insurance companies will. The ones we use most will. And so you can see what your average year over year rate of return is. And in most cases, that's going to be in the 4 to 5% range. Okay? In most cases, you're going to get 4 to 5% annual average rate of return on the non-guaranteed and the guaranteed on the growth inside the insurance contract. So those two ways your insurance contract grows. But that is probably not even the best way it grows, because the third way depends on you. Okay? And the third way that your insurance contract can grow is through investments, outside investments. And that's why we don't call the investment grade insurance contract an investment. Okay? If it were an investment and you stick your money in and it takes a hit at the beginning and then it grows, and by the end you're averaging 4.5 to 5% annual average rate of return over everything, that's good, but it's not great. We don't call it an investment. We call it an investment vehicle, a platform from which you can take your money and invest. So here's how it works. So let's say, just throw some numbers out here. Let's say in year 10, you have a cash value you've put in, we'll say you've put in, 85,000 in contributions, and you have 100,000 in cash value. I'm just making these numbers up, but let's say that's the case. Your death benefit, we'll say, is, $1 million. Okay. All right. So you have $100,000 in cash value. It's grown through the guaranteed and non-guaranteed growth, and you have not yet taken advantage of the potential investment growth. Well, let's say you decide, you know what? I want to see more growth in that. So I am going to now take advantage of number 3. So you're going to go find a property. Let's say you're going to partner with someone else. You're going to go 50-50. You find a house that you could purchase for $70,000. You're going to fix it up and flip it. You think it'll take about $30,000 to fix it up, and you hope to sell it for more. So you're going to put in 50 grand. Your partner's going to put in 50 grand. So what you're going to do is you're going to borrow $50,000 against the 100 in the insurance contract. So now you've got $50,000. Okay. You've used this as collateral. What's the cash value in your account now? It's not 50, it's 100. You haven't touched that money, which means it's still growing on $100,000, right? You're still getting paid dividends. You're still getting paid interest on $100,000. You've got an outstanding loan that's usually around a 5% interest rate, okay? So if you're earning 5% on $100,000 and the interest in the loan is 5%, then you're net positive. Your growth still exceeds your the interest on the loan, and so you're actually getting paid to take out a loan. But I'll do the math for you on that in just a minute. So you take this $50,000, you take 35, you pair it with the other guy's 35, you buy the house for $70,000, you take the other 15 and his 15, and you spend it on supplies and construction and fixing the place up. So you're now, between the two of you, $100,000 into this house. You've put $50,000 in, and let's say you can turn around and sell it for $120. So let's say it takes you a year, because it'll make the math easy. So in a year, you've turned the $100,000 into $120. Half of that profit is yours. So you have earned $10,000 profit on flipping this house. Okay, now if you were to use your own money or the bank's money, that $10,000, would it have to be reported as long or short-term capital gains? And you'd either pay at the long-term capital gains rate if it took you a little over a year to flip it, and that's 15% for most people, or at the short-term capital gain, which would be taxed at your ordinary income if you flipped it in less than a year, right? So that's if you do it ordinarily. Now, in this scenario, your friend gets $10,000. He does what he wants with that $10,000. You're going to take your $10,000, and now, so you've really got $60,000 because you sold the house for $120. You've got $60,000 total, 50 of which, plus a little more, goes towards the loan. So you're going to put $60,000 back in your insurance contract. So let's do the math. We've got $100,000 growing at 5%. We've got $50,000, negative $50,000, growing at 5% against you. And then we've got $60,000 going back in. Now, what's the interest at 100% or 5% of 100,000? That's $5,000 bucks. Okay, so we got $5,000 in growth. Not 50, 5. $5,000 in growth. Okay, on this one, we've got $2,500 of negative growth. So when you add up these numbers, you get 100 minus 50 is 50, plus 5 is 55, minus 2,500 is 5,250, plus 60,000 is $112,500. Okay? So you've taken the cash value was 100,000, and if you did nothing with it and you left it in there, it would have grown by $5,000. So you'd have $105,000 left at the end of the year. But instead, you pulled it out, you invested it, you grew it, you put it back in. So now that's an extra $7,500 that your account has grown by, and that's tax-free. So that's how your insurance contract grows. Number one, guaranteed interest. Number two, non-guaranteed dividends, and that's the growth inside the insurance contract. And then you've got investments, which is growth outside the contract, which you control. It doesn't have to be real estate. It can be stocks. You can invest in your own business. You can invest in your child's tuition. Whatever you want to invest in, you can. No prohibited transactions. So those are the three ways that an investment-grade insurance contract grows, inside and outside the insurance contract. Now, if you have questions about this, or you want to see how this might work in your situation, or how we can use it to pay off debt, to pay for a kid's tuition, to pay business expenses, to supercharge it using bank leveraging, so you see double-digit growth consistently, call my office. My website, ZachariahPerry.com. My contact information is all over the website. Call our office. My promise to you is that whoever answers the phone will put a smile on your face. And if they do not, you let me know, because we take smiling pretty seriously around here.